All right, now let's look at the economic goal of the firm. So every business has a goal. And when we think, very stereotypically, shallowly about business, we think, oh yeah, the goal is to make as much money as possible. But from an economist standpoint, that really is the purpose of a business. As Milton Friedman put it, I think like 43 years ago now, he said, the purpose of a business is to maximize shareholder income from owning that business. And so for the rest of this textbook, unless we otherwise state, the goal of a business is going to be to maximize profit. Now, businesses can have other goals, other short-run goals. They may be targeting specific metrics, so things like market share, revenue growth, shareholder value. Maybe it's technological development. They want to use the most advanced technology possible. All these things are other goals, and if the example requires it, we will specifically point out that this is this other goal that the business is trying to maximize. That's what they're trying to attain. Now, given these goals, the firm is going to have an optimal decision, and that's just going to be the best decision that brings them closest to their goal. And because of that, it's important that we're aware of a firm's goal. Again, typically it's going to be just maximizing profit over the short term, medium term, or long term, I guess, depending on the business and who the management is. But it can also be, sometimes it'll also be these other areas that they're trying to maximize. Profit maximization sounds well and good, but how are we actually going to maximize profit? This seems like a very broad kind of way of looking at it. And how are we even going to know what the maximum profit we can do in this period is? How are we going to be able to measure it versus a world that doesn't exist if we'd have made a different decision? So there's a lot of other economic or financial objectives that firms can use in order to use as like a checklist as a way of seeing if they can make it, how close they are making it towards their goal. So they can break it down, goals in different areas. So maybe looking at market share, the growth rate, things like what is our profit margin this quarter? Has it improved from the previous quarter? Did you reach the target growth? Maybe it's looking at things like return on investment or on assets they have. And again, like I mentioned before, maybe they want to focus on technological advancement. In the short run, the profit doesn't really matter because they're looking for long run advancements. But there are also non-economic objectives that management needs to take into account when they're making decisions in order to, set goals for the company. So some things may be like a good work environment for employees. If you want to be successful in the long run, you need to attract and retain talent. And one of the best ways to do that is to have good working conditions for them. Have them not hate their lives the entire time they're at work. Another is providing quality products and services for consumers, actually making them want to buy the product. Again, in the short run, it may not show up on your balance sheet, but over the long term, you're going to retain a lot of loyal customers if you're offering good products and services. And then there's things that have become a lot more popular over the past decade or so, good corporate citizenship, social responsibilities. Regardless of whether firms should try to maximize profits or not, some people don't believe that companies try to maximize profits. Instead, they mean to satisfice, which means just try to achieve one satisfactory goal. It may not be to do the best, but just do good enough. And the reason is this: companies used to be much smaller. You had an owner-operator who directed the business. They made the decisions. They helped carry out a lot of the actions that the firm needed done. Now firms tend to be much larger, and there's a large number of shareholders, people that own stock in the company. They're technically the owners. Now these people that own stock in companies, I own stock in companies, I'm sure many of you do as well, don't really care about how well the company does. They don't care about making the best possible decisions and earning as much as possible. They're just seeking a satisfactory rate of return. Larger firms tend to be owned by thousands of shareholders. Because there's so many shareholders, it's difficult for them to all get together and reach decisions. They only have small interest in the firm, and they hold diversified stocks in a lot of other firms, a lot of other industries. So just the success or failure of that one company isn't that big of a deal to them. Not only do stockholders have a large portfolio full of other stocks and other assets, they're also much less informed about the firm than management. They don't know a lot of the intricate details of the firm. I'll admit I own stock and I don't go through the financial statements they put out quarterly for the firms. I don't know a lot of the inside detailed information. I don't know, in some cases, a particular amount about the competitors in the industry, but these are things that management are much more likely to hold. So stockholders are fine if they see a satisfactory return. They see that they're making enough of a return on their investment that they're satisfied with what the company is doing. While the company actually could be earning even higher profits, they could be doing even better, the stockholder doesn't really know that. They don't have the information to understand or the amount of time it would take to go and, figure out what the company could be doing better, if they could be doing better. Another reason that companies may not maximize profit and instead just satisfies is the position and the power of management in making decisions within the firm. So high-level managers, so we're talking about like the executive suite, vice presidents, other high-level managers, they're in charge of directing the day-to-day operations of the company. They're setting goals, they're trying to meet those targets, things like that. They tend to own very little of the firm's stock compared to the large number of shareholders that have some ownership say in the company. These managers often tend to be more conservative or more risk averse than the stockholders are in the decisions that they make within the firm. So they may be more conservative. They may be less likely to take risks of like starting new products, jumping into new industries, redesigning the company, changing management structure, things like that. Because if they take a big risk and it pays off, they may get like a promotion, a little bit of stock that they do own, that value is going to go up, but they don't get a huge reward for it. On the other hand, if they take that giant risk and something goes wrong, or they were wrong, and the company struggles, they'll get fired. So there's a lot of downside and there's little upside for them personally. So what they tend to do is be more conservative than would be appropriate. And this is what leaves room so often for entrepreneurs, the proverbial $20 bill left on the sidewalk that the entrepreneur can bend over and pick up. And this is another reason why we've seen like high-level management and CEOs make so much stock compensation. The move was done, redesigning these contracts like that was done to try to align the incentives so the management would have greater incentives. There were more upside if they would take these risks that they should be taking. And not just are they often risk averse, a little too conservative in their decision making, they may be more interested in maximizing their own income and their own perks. Things like making sure that they go to the best locations for the annual board meetings they have, that they have the free flights to the best business conferences to go to. Again, just straight up maximizing their income, making sure they make as much money as possible. So in these cases, incentives are misaligned. If you own the company, if you're a stockholder, you want the management to succeed when you succeed, to make money when you make money, to do well when the company does well. You want the incentives to be aligned, not misaligned. The divergence of these objectives, of the goals of management and ownership, is called the principal-agent problem. But there are also arguments that firms do try to maximize profit in practice. And there are three separate ones we'll look at briefly. The first is that there are large stock holdings by institutional investors, so like mutual funds, banks, things like that. These are professional analysts that buy and sell stocks. They are skilled, and they have the time to do the due diligence to look through, the firm's financial statements, to understand the industry they're in, to know about their competitors, and they can accurately assess whether a firm is, doing a good enough job, if they're actually taking the actions to maximize profits, or if they're just, coasting, so to speak. Another idea is the stock market discipline, that the stock market actually forces discipline for publicly traded firms. If managers don't try to maximize profits, if they're willing to leave cash on the table, that firms face the threat of takeover. So another firm can come in and buy them. You can have, someone decide to buy up a bunch of stock, one of the stockholders, buy a bunch of the stock, use their majority position to force out the leadership of the company. And they can do that to take it another direction because they believe there's profit to be made and the firm was not performing well before under the previous management. And finally, something I touched on briefly just a minute ago was the incentive effect, that many of the executives have their compensation tied to the stock price, and they have, large holdings of stock while they're running the company, and they have that for like their retirement. They get the large amount of stock upon their retirement. The idea being that, tie their wealth, their compensation to the performance of the company. So it's also in their best interest to make sure the company is maximizing profits over the medium to long term. Now, I just want to briefly touch on a couple terms in the maximizing wealth of stockholders section. I don't want to go in depth about the time value of money and how to, compute, cash inflows over time, but I do want to touch on business risk and financial risk. Well, business risk involves a variation in returns due to the ups and downs of the economy, the industry, and the firm. So this risk, all businesses and all organizations, they face to some degree. Some can be really stable from period to period. So things like public utilities, like supply like electricity or gas, or maybe telephone companies, they tend to have more stable earnings over time. Right? There's not going to be a lot of variation in demand from period to period. You're also not going to move up and down with the economy very much. Although people may cut back, and they're spending a little bit on energy during a recession, you're not going to see severe swings. On the other hand, some see wide fluctuations. Some are very sensitive to the ups and downs of the economy. Some of them are going to be are just going to change from period to period. Some could be highly cyclical. So things like steel are highly cyclical based on the economy. So if during a recession, people are not going to be doing like big capital investments, so the value of steel, or people are going to purchase a lot less steel. I guess firms are going to purchase less steel, not people. Maybe companies in high-tech fields are very, it could be changes in consumer wants and needs in the short term. It can be long-term changes in the economy. Financial risk concerns a variation in returns for stockholders that is caused by leverage. So leverage is just the proportion of a company that's financed by debt. So given a certain degree of leverage, the earnings that are going to stockholders are going to fluctuate with the total profit. Now, the higher the leverage, the greater the potential fluctuation of stockholder earnings. So financial risk is directly related to the degree of leverage of a company, how much they're being financed by debt.